With investing, it's about what you keep in your pocket that matters most. Looking at your actual rate of return, net of tax, is far more relevant than looking at gross rates of return before tax. Structuring your investments towards more tax-efficient investment income will ensure that you keep more money in your pocket. There are 4 types of investment income: interest income, Canadian dividend income, foreign dividend income, and capital gains. If you've never heard of fixed income before, it commonly refers to an investment that pays you interest income for a fixed duration of time and then returns your original capital back at the maturity date. Examples of fixed income would be guaranteed investment certificates, corporate bonds, provincial government bonds, and federal government bonds. Fixed income is purchased for capital preservation and interest income. The interest income you receive does not offer any deferral in non-registered accounts and is fully taxed. You have the option to invest in Canadian companies that pay you, as a shareholder, a share of the company profits, usually quarterly, which are called dividends. Many large Canadian companies pay an attractive level of dividend income, such as the Big 6 Canadian banks. Canadian dividend income receives favorable tax treatment in Canada because of the dividend tax credit. You can also invest in stocks outside of Canada, considered foreign companies, like in the United States, and as a shareholder, you could receive dividends. However, unlike Canadian dividend income, foreign dividend income does not receive favorable tax treatment and is treated like interest income for Canadian tax purposes. When you invest in stocks and the price increases over time above what you paid for it, this increase in the price is called an unrealized capital gain. With capital gains, there is no tax paid until you sell the stock. This is known as deferral and is a very important concept. If you eventually decide to sell the stock for a gain, only 50% of the gain is taxable within a non-registered account. This 50% is known as the inclusion rate. There are 2 terms to be aware of for capital gains: an unrealized capital gain, which is the difference between your original cost and the current market value before you sell the stock, and a realized capital gain, which is once you have sold the stock. The Greenard Group approach is focused on the placement of the various types of investments within the different types of registered and non-registered investment accounts. We work to create tax-efficient portfolio to help decrease the amount of tax you pay on your investment income and to help increase your net after-tax investment returns over time. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.